And a very good morning to everyone out there. It is bright and early on Monday morning around 3:30, and yes, I have my cat with me here. I guess this is the stock cat. He came and visited me, but he doesn't really want to stay for some reason. Guess he's camera shy. Do you want to go there, Sylvester? Okay, Sylvester is jumping down, and well, he's just kind of floating around here this morning. And well, a funny thing happened on the way to the big Wall Street panic, and that is that everything has since moderated. We initially started off with S&P futures way down, and now we're only down by 12 points here on the S&P futures, or 1%. Certainly doesn't smell like a panic, and considering how far the S&P futures have come, this is a pretty good picture right now, down by 13 points. I mean, it's nothing to write home about, but who knows what'll happen between now and 9:30. Maybe we'll recover to the plus side. Gold remains a spectacular mover here. It did get to as high as 17.18 on the December contract. It is now up 55 bucks at 17.07, so a little bit off the lows of the day as the price of gold has, or as the stock futures have shifted a bit here and have moderated their losses. Nonetheless, there is negativity around the globe, and these futures can often be indicative of nothing really. They'll show one indication and do something, and then the market will do something completely opposite of what is widely expected. And just briefly looking at, in fact, let me refresh this screen here from CNBC. Well, look at that. FTSE is up by 12 points. Financial Times 100 is up by 0.25%. The DAX index in Germany is down 10, and the CAC 40, is 31 points higher by 0.9%. So that's pretty amazing there in terms of comeback, and it sure looks like they're going to try to engineer some sort of comeback for Wall Street come the 9:30 bell, after there was selling in Asia overnight, but nothing on of the order of panic in Asia. The Nikkei was down 202. Things did look a little dicey there in China for a while. It was down over 4%, but finished 3.7% lower. The Hang Seng Index down by 2% for the Hong Kong market. So there you have it in terms of the reaction to going from AAA to AA plus with negative implications, is that markets have been lower in Asia at least. They are somewhat higher in Europe, and U.S. stock futures are off the lows. So it would appear in these early morning trading hours that things are not as bad as some had been fearing on Sunday. Now, I want to make mention that Timothy Geithner is staying on as Treasury Secretary at Obama's request. That is probably a mistake that will not make anything better for Obama in the political polls. But let's just not even talk about politics, so to speak, this time around. Let's just stick with some market stuff here. And I want to bring attention to France and Italy in particular. It's amazing to see the CAC 40 in Paris moving higher, even with headlines like Societe Generale coming under the danger watch here. And the only reason for these markets to move higher like this in Europe is because the G7 is going to be the plunge protection team of the world. They have committed to doing whatever it takes to limit financial panic, and that's why gold is up, because that means the printing presses are going to be running overtime here to keep things looking somewhat positive within these world markets and for these banks. And you not only have, according to this Daily Mail article, the possibility of big troubles for Societe Generale, but you also have Unicredit Banca, or just simply Unicredit out of Italy, also on life support. But the G7 again is saying that they are going to step in and help out the situation. Similar here in the U.S., Bank of America, liabilities bigger than expected. I wonder who is expecting, or who is expecting smaller liabilities. They obviously are not expecting what most of us have been expecting out of Bank of America and know about Bank of America in terms of accounting trickery and insolvency and all sorts of things. But anyway, this article is pointing out that the liabilities for mortgage repurchases from Fannie and Freddie could be worse than expected as the two companies become more rigid in dealing with the bank. And Bank of America has simply been a complete disaster within the financial markets. In fact, I don't know why I don't have it up here, but let me just bring up stockcharts.com very quickly here. Whoops. Can't spell stock with a B. You've got to spell it with a C. And let's see, that's here we go. Stockcharts.com. And just to do this very quickly here, I'll go to Apple. There's Apple. It's held up pretty well within this market malaise, but certainly not what the Apple bulls want from Apple stock. But anyway, let's go here to Bank of America. Now this is a real sick picture here, and the stock is at $8.17 a share, just barely above the lows of the day on Friday. And really, you want to be here in Bank of America to really participate in the oddity of Bank of America completely imploding shareholder-wise here. This is going to turn out to be another Lehman Bear Stearns thing. There actually had been rumors over the weekend that J.P. Morgan would love to take on some Bank of America. Here's J.P. Morgan stock, $37.60 per share. You would need very adverse market conditions to let J.P. Morgan do another one of these deals a la Bear Stearns, where it was backstopped by the Fed, and if it hadn't been done, they were crying that the sky would have fallen. And perhaps that's the setup here in these markets in the more intermediate term, is for them to continue to fall apart, and then Bank of America could, or rather J.P. Morgan could come in and get away with becoming the bigger beast than it already is at the present time. Anyway, here's the Dow Industrials over the last couple of weeks, and there's something that I should point out here with respect to these markets. Let's look at the S&P 500 as an example. Here we are at 1199, and why don't I bring up a 2-year chart here of good old S&P 500. Look where we're at, 1199, and so we match basically the highs of the spring of 2010. So only a portion of the QE has been undone here. This is all indicative of quantitative easing number 2, going back from September basically of 2010 up to the peak during the spring of 2011, and the lows of the year last year down at the 1025 level are very far away from where we are right now. And this is looking more and more like a real bear market in development. And the message here I have for especially the people who aren't subscribers to the newsletter but who are coming by way of YouTube, Twitter, StockTwits, etc., is that this decline is only getting started, in my humble opinion. If we're really going to be entering into a true bear market phase, well, we don't have to necessarily wait for a 20% decline in the S&P 500. I think the real damage would be more indicated by an S&P 500 that pierces down back to the lows of 2010. Will they let that happen remains to be seen. Will it be permitted for the market to go back to basically the 1,000 level? It's hard to say, very hard to say in terms of market manipulations that do go on with these markets. There's no doubt about it with QE. The QE could instantly bring things back, at least to break even from where they had been earlier this year, for the S&P 500, but you never know. Maybe there is going to be some sort of orchestration to get this market, get the blood flowing in the streets, get it back down to these very, very important areas of support for the S&P 500. After all, if you go back to the financial crisis of 2008, and you notice here, I'm going back actually to 2006 in this chart. Maybe I should actually, let's take this actually back even further. Let's go back by about 7 years here for this particular market. There was, as you recall, in 2007 and 2008, especially in 2008, there was a lot of debate here amongst the bulls and the bears during the early or late 07 period going into 2008. Is there a bear market? I was working at CNBC at the time and writing up all kinds of kooky articles for them where they were constantly taking the bull case. They wanted me to write up positive articles, although they didn't say we want you to write up positive articles because we want to cheerlead the market, but that was the message that I basically was getting, is to write up positive articles. So there was all this debate on CNBC, and then the bottom fell out of the market here, basically. Once we broke past older lines of defense on the S&P 500, it's a nasty downturn. And all I'm saying here is that by looking at these levels, these are going to be very important, just above the 1,000 mark, to validate a really scary and true resumption of the bear market. Let's hope that doesn't happen to a lot of people out there who have really gone through quite a bit to get their 401ks back from the damage that had been wrought in 2009 at the low of the market. So keep an eye on this 1100 level down towards around 1,000, and even if the market bounces back today in the next couple of days, for whatever reason, if this is a real bear market, the drop is going to continue for the stock market. You should never underestimate the power, especially when you look back here at 2008, 2009, that what can happen to the stock market in a bear market. If they had them here, I'd show you charts of the 1970s, and we could have a long discussion about 1974 and what happened in that particular bear market for stocks. So I'll leave it at that for now. Now that we're looking at the possibility in the early morning hours of some sort of bounce back for the stock market, and if we do see that bounce back, 1225 is probably a good resistance area to the upside. We're now at 1199 area. Keep that in mind. And if the bounce back doesn't materialize, well, look for at least 1150 and then down towards the 1100 level as downward targets, ultimately back to the lows of 2010 around the 1000 mark. So have a good morning. I'll update this as needed, maybe a little later on today.